our special guest on this Friday, Wharton School professor Jeremy Siegel. He joins us once again. You know, you've been with us on a bunch of Fridays, Professor, which I love because it gives us a chance to kind of sum up what's happened in this stretch ahead of us. And today, of course, it's all about the Fed chair. What'd you make of the speech, first and foremost? And what do you think this market reaction now says about it?
Well, first of all, there was really nothing new that he said in the July FOMC meeting. In fact, I was disappointed because what's happened in the market, as we all know, is that yields have risen, real yields have risen, real growth has risen, and the reason that real growth has risen is because productivity has been so strong. He didn't address any of that. He seems almost stuck in that mode. Real growth is higher. That means more workers. That's more pressure on wages. That means we might have to go higher. And that's not the story. The story is we're getting real growth higher because we're getting productivity higher. In fact, the labor market is slowing down. I mean, expectations for next Friday are about 160. Less than half what we had last year. So in some ways, I don't think he really addressed what the market has been seeing over the last few weeks. That's why I said I think some people got a little bit nervous at the beginning. The market sold off. Now they said, hey, you know what? There's nothing new. We're going to gain back what we worried about yesterday. Market down 300, now up 300.
I got to be honest with you, Professor. You know, I heard, and, I don't know, maybe I was hearing the wrong thing. I heard a Fed chair who suggested that maybe the bar is a little higher to actually do more than some others would like to believe. And I say that because of these words, quote, uncertain about the lags, might be significant further drag in the pipeline. He also mentioned the risks of doing too much. That tells me that they're not quite sure what's yet to come, and they're going to be real careful because they don't want to mess it up. They don't want to snatch defeat from the jaws of victory.
I think you're right there. And in fact, we detected that as you and I had talked about after the July FOMC meeting. He became much more two-sided. He became much more aware that there are downside risks. I think he heard from 2 or 3 voting FOMC members that are saying, we have done enough. I think he looks at rising delinquencies and credit cards. We've been hearing that on some of the earnings calls. He looks at other, what's happened to mortgage rates at nearly 7.5%. So that he mentioned that little pickup in housing. We don't know how long that's going to last. So I think that is on his mind. How, even though his orientation has been, we may have to do another quarter point. Probably we're going to bypass September. We're going to look at things and see how things are going to be for the November meeting.
Is that the most you see happening? One more hike, and perhaps that's in the fall. Is there a chance that they are actually? Is there a chance they're actually done?
There's a chance that they're done, and unless the inflation news turns dramatically worse, and the only way we can really do that if the dollar goes way down, which it's been going up, if oil keeps on going up to 100, 110, 120. Although they're supposed to ignore, food and oil as being more temporary. If commodity prices begin rising, which they really haven't. Now, those have stabilized, to be sure. But we're not seeing the inflation in those components and housing, particularly, that we saw in 2021 and 2020 and 2021. So unless those things happening, of which there's no sign, it's got to be at most one and done. And if there's a little bit more of that downside risk and saying we can hold off, then it's done and done.
Wow. What about the correction? Is it done? Right? We're down, 4% or so on the S&P from the recent high.
Yeah.
Do we have to go much further lower, or what's your guess?
September for decades had been the worst month of the year. And then when all that used to get published, I published a lot of that in my book. Everyone said, well, then we better also in August, if September is the worst month. And then August became a tough month, especially second half of August. And I think that is being challenged. And of course, the higher real interest rates are certainly challenging the stocks at the same time. But I don't see any major crack. I mean, it may have a few more percent to go. Could it dip into correction territory? Possibly with some really weak news, but that is about all. After that, we have September, October, choppy months, news months, November, December usually being much better, year ending on an upturn. So I think for the rest of the year, we're stable to upward, and we have the 15 to 20% rise. And if he doesn't raise it anymore and says inflation's falling, it could be 20, 25% for the full year.